Hi, friends. This is Steve at New Compass Crypto. Thank you for joining us as we're talking about the current state of the economy and my outlook over the next 6 months for both the economy and for the prices of Bitcoin. So I'm going to share 4 charts with you. So we're going to start over here with, this is what the dollar has done over the past year. So this is the dollar index, this is the dollar against 6 major currencies. As you can see, last year at this time, we had a relatively weak dollar. It was at 94 cents relative to the pound, the yen, the other 6 major currencies, the euro. But over the past year, it has climbed. So it reached parity, which is, we want 100, so $1, right here around April. And people still were not talking about the strong dollar. That's a neutral dollar. A neutral dollar at 100 is neutral. But then look at what has happened between January and now, whereas at 114, and currently it sits at 100, right above 112. It means that the dollar, 100 cents, is now worth 112 cents versus those 6 major currencies on average. That is what people mean by having a very strong dollar. So the dollar is traded on open exchanges, just like stocks, bonds are. And the dollar this year has done very, very well. So why is that either good news or bad news for us? So the good news for us is that as Americans, we benefit from a strong dollar, but we only benefit from a strong dollar if we go overseas and spend our dollars elsewhere. So right now, if you were to buy a flight to London, the flight getting there is very expensive because you have to pay in US dollars, and the price of flights has gone up because of inflation, supply and demand, other issues. Once you get to London, your dollar will buy 12 cents more per dollar than it did at this time last year. And it's actually even more than that because, remember, the dollar index graph that I just showed you is the average of the 6 major currencies against the pound specifically. It has really fallen. It has gained almost 50%. So therefore, you can buy almost twice as much this year in London with your dollar as you could last year. So that's wonderful news. So why wouldn't we want a strong dollar? Why don't we want the dollar to go to $1.50, $2? Why don't we want it to go to 150 cents or 200 cents? Because every time the dollar increases for us, it actually hurts the other countries' economies because they are not purchasing in dollars. They're purchasing in pounds, they're purchasing in yen, they're purchasing in euros. If they are weak against us, it means that they have less purchasing power. So our multinational companies, Amazon, Microsoft, Apple, who have most of their profits, a third, a half of their profits come from overseas, for the people that are overseas, their prices, their real prices are actually rising against the dollar so they can buy less iPhones, they can buy less goods through Amazon, so anything made out of China. So therefore, it's going to hurt the multinational corporations' earnings. And that means that it hurts the US stock market, which is bad for us ultimately. So let me share another graph with you for 1 second. This is, the next one I want to show you is US inflation. So what is the US inflation doing this year? US inflation is CPI. And it's all you've been hearing about on the news lately. Right now, we are right here, and the last report came out at 8.2. You can see that in June, it hit right here, 9.3, and then again in August, it hit 9.3. Every time thus far, we think there's been a recovery, like, oh, inflation has peaked, therefore the US markets are going to do well. it actually has gotten worse. So inflation is not falling fast enough. What is inflation? Inflation is that your buying power of US dollars within the US. So I was just talking about a really strong dollar. It's now worth 112 cents. Shouldn't I be able to spend more here and still, come out ahead? You can't, because inflation has been creeping up. If inflation is at 9%, then your dollar in the United States is worth 9% less today than it was worth at this time last year. How does that make any sense at all? Okay, well, imagine, have you ever seen, you've been on an airplane and you've seen a fly on the airplane. The plane takes off. It's flying at 500 miles an hour. Is the fly flying at 500 miles an hour? It's not. It's flying at the exact same speed as the airplane. Therefore, relative to the airplane, the fly is only flying its normal speed. What does this mean? This means that if you're sitting in coach, which you bought with your US dollars this year, next to you is the price of lumber, but you're buying it within a US store. You go to Home Depot, you go to Lowe's, and you buy lumber. Throughout the course of this year, you have seen the price of lumber get up and walk over to first class. It got up from its coach seat and went on over to first class, a much more expensive seat. The same thing has happened with the price of oil. The price of gasoline for much of this year was very high. The price of food has been very high. Therefore, you're sitting in coach going, hey, wait a minute, I'm still doing well. I'm making the strong dollar here. I'm with the United States. USA is number one. But relative to you, prices within the US are getting up and going to first class. Now, there's a few prices that are falling. The price of housing is beginning to fall, but it's getting up from its coach seat, and right now it's going like back to the back of the airplane. So it's not that much. It's not that much of a savings. What Jerome Powell, the head of the Federal Reserve, he insisted, his close friends call him Jay. What Jay wants housing prices to do is to put on a parachute, open up the airplane door, and jump out of the airplane and fall faster. And that's not going to happen, or it has not happened yet. So therefore, relative to what you and I are spending, our dollar is buying less, even though on the open markets internationally, the dollar is worth more. I'm now going to share a third chart with you. The third chart is actually kind of fascinating. This is the 2-year note. The 2-year note is the Treasury yield note. Now, why am I talking about treasuries? Treasuries are traditionally safe havens where people go when the stock market is volatile, when inflation is very high and uncertainty reigns everywhere. This is that the United States government is saying, if you give us your money for 2 years, the US 2-year note, the bond yield, you buy a 2-year bond, and we are 100% guaranteeing that we will pay the interest rate that we are telling you today we're going to pay on it. What has happened to the interest rate of the 2-year bond? In November, look at this. A year ago, it was under 1%. That's what you make on your savings account. You don't want those kind of savings. You laugh at those kind of savings, especially as every year in the stock market for the last 11 years, we've had this bull run. It's been doing, 10%, 11%, and really great years, 20%. So you spit on this 1% guaranteed return. You don't want that. But look what has happened over the past year. It is now over 4.2%, almost 4.5%. Guaranteed return. if they hold your money for 2 years. Now, why is this an issue at all? Well, it wouldn't be an issue at all if you're in your 30s or in your 40s and you say, I can absorb 1 year's worth of losses in the stock market. The stock market is down this year 30%. I don't care because I have plenty of time for the stock market to correct and continue to make me money over the long term. And that's nice. And that is in fact true. But what if you're 60 years old? What if you're 65 years old? What if you're 70 years old? And you don't have that kind of time horizon. And those people hold the majority of wealth in the US. What they're going to be looking at is they're going to be saying, oh my goodness, my portfolio is down 30% this year. No. I need that money to live on sooner rather than later. I need to take money out. So I am going to maybe buy this bond over here at 4.3, 4.4% return, guaranteed return. Now, it's not great. It's not a traditional year in the stock market at 7, 8, 9, 10%, but it's 4.5% when the stock market is falling 30%. So you might take some of your money or even the bulk of your money and put it there if you're very conservative. And if you're very conservative and you put the bulk of your money there, that is money that is coming out of the stock market. Out of the stock market into the bond market. It stays within the US, but goes from one market to another, and that causes markets to fall. So that is another reason why the stock market has gone down this year. So what does that mean for us for this year? It means a variety of things. It means that Bitcoin, which some people speculated was going to be a hedge against inflation, and lo and behold, inflation began to creep up this year. And the price of Bitcoin tanked, and they said, oh, no, it's not a hedge against inflation. Maybe it's a store of value. Well, what is a store of value? A store of value is, what is it doing relative to the price of gold? Bitcoin has actually held up relatively well toward the price of gold. And over the last 10 years, it's done great. But for this year, it's most closely correlated to a tech stock, a high-risk stock. The NASDAQ 100 has been the best correlation over the past 9 months to the price of crypto, specifically to the price of Bitcoin. So what has happened to the price of Bitcoin, and what are we going to see in the long term? I'm going to show you the last 4 months of Bitcoin. The last 4 months of Bitcoin, as you can see, the high has been over here around 25,000, the low around 18,150. Traditionally at newcompasscrypto.com, what we did is we said, what we're going to do is we're going to go into a trade. We're going to put in 10% of our allocation, and then we're going to move 20% profit on that allocation, on that one bet. So if you had $100, you would bet $10, and then you would wait for that $10 to move up $2. So you'd buy at 10, you sell at 12. But if you did that with Bitcoin over the past 4 months, the price of Bitcoin has only moved 20% one time. It moved from here to here. So you wouldn't have been placing any trades since August 15th. The price of Bitcoin has not moved 20% at all. So then we had to look at changing our strategy, and we said, okay, well, what if we moved 10% per trade? If we moved 10% per trade, yes, you got this trough here. If you bought here, you could have sold here, and then one more time here and sold here. That would have been a 10% rise. So you could have made 2 trades. Okay. That's still not going to get you very far if you're only putting in 10% of your allocation. So what are you going to do? Our new strategy that we're going to be using moving forward, and that I recommend that you do, and certainly with your paper trading, that you do for the next 3 months and probably for the next 6 months, is we're looking at getting in with a little bit more of our portfolio, around 50% per trade, but we're only going to wait for it to move between 5 and 7%. Why 5 and 7%? Let's look at the chart. If you got in here, you could have got out here. If you got in right here, you could have gotten out here. If you got in here, you could have gotten out here. Same thing from here to here, here to here, right here to right here. All of these peaks and troughs over the past 4 months, you could have gotten at between 5 and 7%, 20 times. So for us, it is going to be better to trade more, to allocate a little bit more of our portfolio, 50%, and to take a little bit less of a bite. And that bite is going to be between 5 and 7%. I'm advocating that over the next 3 or 6 months because the only way Bitcoin is going to move drastically to the upside is if we have a major run in the NASDAQ over the next 6 months, a major bull run. And I don't believe that we're going to get a major bull run. Why? Because as you saw, the dollar is very strong. So corporate earnings, especially multinational earnings, are going to remain. They're going to do okay, but they're not going to fly through the roof. Bond yields, unless they come down significantly from 4.2% and come back down into the twos, people are not going to take money out of their stock market and inflow it back out of the bond market and inflow it into the stock market. And CPI, unless it moves into the 7s, the 6, and the 5%, it is not going to go down enough for an influx of money to come into the stock market. Therefore, an influx of money is not going to come in a major way into Bitcoin. And I believe that it's going to stay at a trading range of somewhere in the low end, 17,500, the high end, 21, 22,000. So we're going to be getting in at various prices, but right now our target range to get in is going to be between 18,500 and 18,750. And then we're going to be getting out at 19,700, 19,800. And we're going to look to replicate that over and over and over. You're going to follow along with us on your paper trading at CoinGecko. And that is what we're going to try to do until a couple of things need to clarify. We need to have the election clarifies, the midterm elections, which are happening in a couple of months. And we need to see what is happening with the UK, what kind of government policy they're going to accept, what kind of economic policy they're going to go with. Now that Liz Truss resigned this morning, which was a little bit of a shock. She was in office less than 6 weeks. But certainly now they're probably not going to move into these huge tax cuts that they were going to propose. So the United States needs to continue to tighten rates. Jay Powell has said inflation is his #1 priority, especially when unemployment is staying low. Unemployment is still at 3.5% within the United States. That is historically low. So Jay Powell is going to take rates and keep on increasing them. By how much? On November 2nd, he's probably going to increase another 75 basis points. And at the December meeting, probably another 75 beyond that. That's another 150 basis points, 1.5% from where they are today. That means that your 30-year home mortgage, which is currently at 7%, could very well hit 7.5%, 8%. Auto loans are going to get more expensive. Credit cards are going to get much more expensive. And that's what he wants to happen because he wants spending to come down. If spending doesn't come down, prices don't fall. And in a rate tightening environment, we are not going to have a massive sustained bull run, which is going to cause Bitcoin to go from 19,100, what it is right now, up again into the 40s, 50s, 60s. So we are going to be in this trading range. And if you join us at newcompasscrypto.com, we're having our 6-month free beta program. We're offering all our services for free. Please come and join us. We're going to keep you updated on the equities on the cryptos that we buy. Right now, we are buying Bitcoin. We're going to buy Ethereum and we're going to buy Solana. And we're not buying other things. They are too risky, especially in this environment. But we will keep you updated on the prices that we enter and exit out of. And our goal is to do well for us and to do well for you. Thank you for joining us. Don't forget to like and subscribe. We'll post this on our website, newcompasscrypto.com, as well as our YouTube channel. Take good care. Thank you for joining us. Bye-bye.